back to EDS, and in this video I'm going to reveal to you the secrets of how to actually be profitable long term with options. I'm going to show you why a lot of the stuff that you see out there doesn't work in today's world. So to start off with, why do most things not work? Well, most people buy options, and when you're buying options, you're trying to turn a little bit of money into a lot of money. We're going to be taking the opposite side of that trade, and we're going to be selling the contracts or writing the contracts. And what this is going to do is it's going to give us a very high win rate, because you can't turn a little bit of money into a lot very quickly. However, what you can do is consistently make returns like a casino or an insurance company. It requires a little bit more money. You can still do it with small accounts. I'm going to show you how, but your returns aren't going to be turning $100 into $1,000 in one trade. You're probably going to be turning $1,000 and making a $100 profit off of that. So it's literally the opposite of what everybody else is doing, and I'm going to show you what to do. So the first thing is you want to open up a watch list. We're just going to use a 52-week near high watch list. This is going to show all underlyings right now that are near to their 52-week high, which is basically the highest point it's been over the last year. And we're basically going to take the trade of assuming that price will revert. It really doesn't matter, but it just gives you a bit of directional bias, I guess. We do have strategies that we use where we don't guess direction at all, but if you're starting out, this will be a good place to start. And you want to, once you got your watch list open, you want to have your IV rank on your watch list, and you want to order your list from high to low IV rank. And you only want to look at things to trade that with an IV rank of over 30. Over 30 is high, over 50 is very high. Anything less than that, you don't really want to look at it. And we're going to have a look at GLD here. We're going to have a look at GLD. Or in fact, let's have a look at BABA. BABA seems to be quite nice. It's trading at around $134.50. It has a very high IV rank of 76. I believe BABA does have earnings coming up soon, which is why the IV rank is probably so high. It has an absolute IV level of 54.6%. So we're going to open up the trade tab, so where we can see a list of expiration dates for BABA or for your chosen underlying. And as you can see, there is earnings today. So hopefully we can get a bit of vol crush, or get some volatility to contract out of the market, and that will be good for our P&L. So when selecting an expiration date, you want to choose something that's between 30 and 60 days out in time. You want it to also ideally be a monthly expiration date, not a weekly. So we've got the 56 day out contract here, April 17th. So we're going to open that up, and now we can see the options chain. Now ordinarily, most people, as we mentioned at the start of this video, will be buying contracts. I'm going to show you how to sell them. So when you're selling contracts, you basically want price to stay away. When you're buying contracts, you want price to go through your strike. If you're buying an out of the money contract, if you're buying an in the money contract, you basically want price to keep going in that direction. Basically, when you're buying contracts, when you're long contracts, you want price to breach your strike and keep going. When you're taking the other side of the trade, when you're selling contracts, you want price to stay away from your strikes, from your contracts. So what we're going to do is we're going to use this bar here, which is the expected move bar, this orange vertical bar. This is showing you the expected move of the underlying over the next 56 days. If your broker doesn't visually display it like this, in the top right where it shows you your IV, in parentheses, there'll be your expected move plus or minus 17.96. It's pretty much a standard format for most brokers, so just look in the top right and it should show you expected move. And now that we know what the expected move is, and we know that we want price to stay away from our contracts, we're just going to sell contracts outside of the expected move, and that's going to give us a high probability of success. The further out you go, the higher your probability of success, but the lower your return will be, because you'll collect less premium. So when you're buying contracts, you're paying the premium. When you're selling contracts, you're collecting the premium. So we're going to sell contracts outside the expected move, and we want to sell them around the 1 standard deviation level. That gives you a good risk to premium balance, and that typically will line up with a delta of around 15 to 20. So let's go with the 17 delta on the call side. As you can see, we have our delta column here, 17 delta on the call side, the 170 strike, and we'll go with the 15 delta on the put side, You can see we have our negative deltas here on the put side, so 15 delta at the 115 strike. And what we've done is we've now created a range for ourselves. We want price to stay within this range and be within this range at the point of expiration, which is in 56 days time. Our pop here is displayed in the bottom left corner, which is 75%. So that means we have a 75% chance of making at least a penny on this trade, which are super high odds. And if you wanted to get out of this position at 50% of max profit instead of holding all the way to expiration, we have a P50 here of 90%. So this is why when you're buying contracts, most of the time it won't work out in your favor, because the person that's selling the contracts or taking the other side of the trade, the odds are in their favor to win that trade. So you know, this is the more sustainable long-term approach. And you know, as we mentioned, you're not going to turn a small amount of money into a large amount of money on one trade. You can over time, but not with one trade. So for example, here we're going to collect $450 up front, and our broker is going to require 4.7k in buying power. So as you can see, a little under 10% return in 56 days, which is still a very nice return. However, it's not it's not $100 to $1,000. You know, you can just collect consistent premium and build up your account. Now you might be thinking, you know, 4.7k, that's too much to allocate. Maybe you have a smaller account. Well, what you want to do is you want to use some of this premium to buy some contracts further out, to cover your short contracts. And because we're going to be buying it further out, they'll always cost less, which means that we'll always end up with a net credit, or we'll always be able to collect premium. We're never going to be paying to open these positions. We're going to be getting paid to open these positions. So let's say if we just go, you know, 2 strikes out, $10 wide. We do the same thing on the put side. So now we've got a $10 wide spread on either side. As you can see, we've used some of our premium to pay for those long contracts, and now our buying power requirement has significantly been reduced, because our buying power requirement is now calculated based on our max loss, which is now defined as the difference between our short and long contracts, which is $10 minus the premium that we collect up front, times by the contract multiplier of 100, and we get our max loss of $800. Our broker knows what our max loss is, and it only needs to hold that much in buying power, which is why our requirement has reduced so much. We're going to collect $200 in this instance, and our broker is going to hold $800 to open it. So as you can see, now we're getting about a 25% return here, which is higher than what it was before. Our pop has dropped slightly by 5%. Our P50 is still between 85 and, you know, sort of 88%. So still very, very high probabilities of success. You know, you can be more aggressive. You can go to, say, the 25 delta. If you wanted to still keep your strikes the same width, we'll go to the 22 delta on the put side, just because there's no 25 delta there. And as you see now, we collect more premium, and our our return on capital has increased because our spread width is still the same, $10. We now collect more premium, so it's $10 minus 3.3. What's left over that times by 100, you get our max loss. So now we're going to be collecting $329 up front, and our buying power requirement is going to be $676. So now we're getting close to a 50% return, or pretty much almost a 50% return here. Our pop has dropped slightly to 60%, and our P50 is around 75% now. And this is the kind of balance. I wouldn't really go too much heavier than this. You know, if conditions are right, you could maybe go to the 30 delta on either side, but you know, you want to kind of stick to the 15 to 20 delta range, and you want to kind of get out of this position at 50% of max profit. And that's it. You just do this over and over and over again. Make sure that your position sizing is correct, and have as many occurrences as possible, and over time you will make money, and you just let the odds work out in your favor. You want to have as many occurrences as you can to eliminate short-term variance. Obviously, if you have a smaller account, you may just have to ride out the variance, but as long as you just understand and know that long term you will make money doing this, you just need to do it again and again and again. You'll be absolutely fine. To know how much buying power you should be allocating to your positions, we've created a free position sizing template. The link is in the description. Just click the button and it will take you over to this spreadsheet, and you enter in the size of your portfolio at the top. Below, you can then enter in whatever the current VIX level is, and it will calculate how you should structure your portfolio for you. So it takes into account the VIX level, and the VIX is basically, market volatility, with the volatility of the S&P, which is the market. So it's taking into account the volatility in the market and dynamically calculating how much buying power you should be allocating to defined risk positions, undefined risk positions. How much of your portfolio you should be allocating to short premium. In this instance, if you have a $15,000 account and the VIX is at 21.4, you should be allocating about 35% of your account to short premium, which works out to about $5,250. The rest is, you can just keep it as cash. If VIX increases, and you can allocate more. You can buy and hold the S&P, you can sell puts against the S&P, just some lower risk kind of stuff. If you want to, everything is explained here beneath, so there's no guessing that needs to be done. As long as you follow this, you'll be absolutely fine over the long run. If you would like to learn in more detail about what we do and how we do it, again, the link will be in the description. This time, click on EDS Premium and get yourself signed up. Inside, you'll have access to one of our portfolios that will allow you to see the positions that we place, how we manage risk, how we make adjustments, all in real time. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you get stuck at any point, you can speak with myself directly or with other like-minded individuals. There's also a 100% money-back guarantee, so once you have studied the full course, follow some of our trades for at least 6 months. If at that point you are not profitable, we will work with you for free until you are, or you can simply request a full refund. Right now it's $9.99 a month to join. The price will be increasing. With every wave of members, we increase the price. It started off at £1. The first wave was then full. We increased the price now for the second wave. Once the second wave is full, we'll increase the price further. So you are rewarded for getting in early, because whatever price you get in at, that's the price that's locked in for you. Once you're in, you don't need to worry about price increases. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill, and once you've learned it, no one can take it away from you. You can take it with you for the rest of your life, and we want to get you to that point of where you are self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.